I am going to welcome the next panel here, which is going to be moderated by Antonio Zuniga from Oakshore Capital. Antonio is the managing director there, and going to introduce the topic. He's going to introduce you to the other panelists. And with that, Antonio.
Please, thank you for putting this forum together. I'm delighted to be here along with our fellow panelists. With us today, we have some professionals in the debt and direct lending space, both originating and acquiring existing debt, both in commercial and residential. So I really welcome an interactive session with our audience. We should be able to field any of your related questions. I'll actively monitor the chat, work your questions in during our prepared portion, and we budgeted time at the end to respond to your other questions. I guess before I pass it on to my colleagues, let me introduce myself. My name is Antonio Zuniga. I'm Managing Director at Oakshore Capital. Oakshore is an investment management firm seeking absolute return strategy in the consumer receivable space. Personally, over the past 20 years, I've been involved across many facets of real estate, banking, and debt. Perhaps most applicable during this incredibly fluid time. During the crisis, the previous crisis in 2008, I was an initial investor and an active director at a community bank that opened just prior to in 2006. And we really had to learn how to pivot and grow during the crisis before later merging with another local bank. And we eventually filed for IPO a few years back. Mike, next slide. And next slide. Specifically to Oakshore Capital, we buy monthly portfolios of charged off consumer debt directly from originating lenders. We use third-party collection agencies to create funds of diverse monthly front-loaded cash flow. And thankfully, especially for cases like this, we're uncorrelated to the majority of traditional asset classes. Next slide. More specifically, we focus on debt that's liquidates much faster than the 5 to 7 years. Plus charge-off credit card debt favored by the largest private and public institutions. We like forward flows. So that is to say, monthly purchases of portfolios from the originating lender month and month over and over for 6, 12, 18 months, contractually obligated. Is that the banging that someone else is on?
Yeah, it seems like it's gone now, Antonio.
No worries. I just wanted to make sure it wasn't here. So yeah, forward flows are a really key part of our strategy for 3 critical reasons. First of all, it helps us create great diversification in each of our funds over a relatively short period of time during the acquisition period. Secondly, it simultaneously keeps cash drag to a minimum and keeps us fully invested throughout acquisition until fund closing and monthly distributions begin. And lastly, it really aligns all the stakeholders, not just the lenders we buy from, the collection agencies that help us collect on the debt, the borrowers that we work to make payment plans with, as well as the investors, both myself as the GP, as well as our LP partners. I think for the time being, let me stop there. And pass it on to, I can come back later in the panel. With that, I'd like to let each of my colleagues introduce themselves. First, I'd like to invite Rafael Serrano with Safe Harbor Equity to speak.
Thank you, Antonio. Good afternoon, everyone. Can you guys hear me okay? I just want to confirm that I'm audible.
You're great.
Okay, great. Thank you. Well, thank you again, Antonio. So my name is Rafael Serrano, and I am the managing partner of Safe Harbor Equity. Safe Harbor Equity is a private equity firm, and we specialize specifically in generating above average returns for our investors that are uncorrelated with the broader markets. To date, we've launched 3 fund vehicles that specialize in strategic acquisitions, origination, management, and repositioning of non-performing assets backed by real estate mortgages. I founded Safe Harbor in 2005. 10 years we operated in a managed platform capacity, and in 2015 we moved to a more traditional private equity fund format, and then have gone on from there and now on our 3rd fund vehicle. Next slide, please. Thank you. So amongst our competitive advantages, which is what this slide addresses, is our ability to execute transactions extract value from each investment, and our expertise in litigation management help us navigate the foreclosure process much faster than other companies. Thorough credit underwriting, a detailed analysis, and due diligence process are the backbone of extracting value and capitalizing on the opportunities that we experience. We conduct in-depth financial analysis of the borrower, a collateral analysis. We also maintain a strict adherence to value parameters and lending guidelines, as well as a high-touch loan servicing platform that is all done in-house. Next slide. And then this slide touches on the market opportunity. The U.S. mortgage market is $15 trillion approximately in its size and scope, with approximately $4.5 trillion in commercial real estate mortgage loans. Even a small percentage of increase in this space is a huge opportunity in non-performing loans and provides billions of dollars of opportunities that can extract value from. Our goal with most non-performing loan purchases is to work with the borrowers to establish a plan and get loan payments up to date. If we're unable to do so, we go through the foreclosure process, prosecute the foreclosure, and will then take title to the underlying collateral, which we believe is a high quality asset with significant value above our purchase price. Thank you for your interest, and I'll turn the call back over to Antonio.
Hey, thanks, Raphael. Next, let's Mike Griffin from Hedge Act, if you could give us your introduction.
Great. Thank you, Antonio. My name is Michael Griffin. I'm the CEO and founder of Hedge Act, a registered investment advisor. We have approximately $250 million in assets under management. We are a sponsor to several alpha-generating alternative investment vehicles that seek to provide superior risk-adjusted returns that are non-correlated to the broader asset classes. Our strategy here today is a medical receivables litigation finance fund. It is a fully secured lending fund. We basically loan money to medical receivables factoring companies who in turn purchase receivables from their network of medical service providers at a deep discount. Through our funding, we're able to offer victims of personal injury cases the ability to seek immediate medical attention at no cost to themselves, thereby providing a social benefit. Our fund is fully secured. We secure the collateral through an assignment of or liens on the underlying medical receivables. This collateral typically represents 200% or more of the underlying loan. We also have a UCC filing over all of the assets of the underlying medical receivables companies. Because we're not purchasing receivables, we have a specified loan agreement that has a stated interest rate of 19%. Other terms include a 6% repayment fee, and we also, in some instances, charge a 2% origination fee. The loan must be repaid within 30 months, irrespective of the collection by the receivables company of the underlying receivables. Next slide, please. In terms of return, we're targeting for our investors a mid-teens to low 20s net return with very minimal negative volatility, if at all. We achieved a 17.5% return during our first year of operations. Thank you. Back to you, Antonio.
Hey, thanks, Mike. Matt Gilbert from Reef Investment Management. Mike, next slide. Perfect. Matt, are you with us? Mike Cricelli, do you see Matt on your list?
Can everybody hear me now?
Yes, we can. Thank you.
Okay, sorry. I guess the audio on my phone for some reason isn't working. Is the audio coming in okay?
You're loud and clear. It looks like you had the opposite problem that I did, but go right ahead.
Okay, no worries. Well, listen, thanks, Mike, for arranging this terrific panel, and I'm grateful, Antonio, for your chairing. My name is Matt Gilbert. I'm the managing director of Reef Investment Management. If we can go to the last slide, the triangle one. There you go. Great. So I'd remind everybody that our full market outlook is posted in the data room. I think you'll find that interesting while also being blessedly short. I'm grateful to be speaking to you live from my home office bunker. Just want to issue a quick warning. I believe it's suitably fortified against my little ones invading, but in case you hear any type of screaming in my voice, but 10 octaves higher, that would be my 3-year-old. I'm sure many of you working from home can relate. So let's talk about Reef Capital Partners. Our firm is a real estate investment company in business since 2005. We source, service, and manage commercial and multifamily real estate investments in the United States. We have over 700 high net worth and ultra high net worth individual investors and institutions, including Crestline Investors, among others, where we are a sub-manager in their Opportunities Fund. We offer participation in direct lending, in other words, short duration, senior secured commercial real estate bridge loans at an average return of 12% net to the investor and an average loan to value in the low to mid 50s. We offer funds, pooled vehicles, which take syndicated positions in those loans, offering a net 10% preferred return, cash flowing monthly, and a 1 to 3 year duration. We offer protective advances, which offer an 8% return on a 3 to 18 month duration with principal and interest guaranteed by our company. And finally, we do 3 to 4 terrific private equity real estate transactions, each targeting 20% plus annualized returns, 40 to 50% depreciation offset, high growth markets, and a 2 to 3 year principal commitment. We co-invest in every deal we do and are always looking for new investors to join our family with minimum starting as low as $50,000. If we go to the previous slide, please. There you go. We're one of the few middle market lenders who survived and thrived in 08 and 09. There are many reasons for that. I'll go into them later, but most important is our commitment to capital preservation and our unique business model. I'm very much looking forward to participating on this panel. Thank you.
All right, Dave, thank you very much, Matt. Dan Lee from Comvest Partners, last but not least.
Hey, Antonio, can you hear me?
You're coming in great. Maybe come a little closer to the.
Okay. So good afternoon, everybody. Mike, thanks for hosting this, and Antonio, thanks for chairing. Dan Lee with Comvest Credit Partners. We are part of a private equity firm in West Palm Beach with about $4 billion of assets under management. We have two strategies: our private equity control strategy and our lending strategy, where I'm a partner. We have about $2.5 billion under management on the direct lending strategy. And so what we're doing is primarily senior secured loans against the cash flow or enterprise value of the assets to middle market borrowers, means 10 to 50 million of EBITDA, in a mix of sponsored, non-sponsored, and non-traditionally sponsored companies. And we're looking to target high single digit to low double digit coupons with a floating rate. In terms of strategy, on the next slide, we're part of a private equity firm, and so we're looking to utilize those resources, the operating partners and our investing experience in targeted industries to find deals that are a better fit for our risk profile. We're also targeting less competitive market segments, and so that means underbanked market segments and non-sponsored and non-traditionally sponsored companies. And we seek strong investment structures to protect us, predominantly first lien with robust covenants. And we think when we put these together, it allows us to generate more compelling risk-adjusted returns, which means pricing premium and lower leverage multiples with tight covenants. Next slide. And for the money slide, this is really the proof in the pudding. If you're familiar with the direct lending market, you know that pricing has been going down significantly since 2010, 2011, and leverage has gone up meaningfully. We've maintained our discipline by using that strategy and our investment structures to keep our returns consistent while moving up the capital structure through the cycle, keeping leverage between 3.5 to 4.25 consistently, and at loan to values hovering around 50%. And so with that, I will turn it back over to Antonio.
All right, I appreciate that. Okay, well, I am looking forward for us to dive into both what our present, both personally and in our businesses, how the COVID-19 pandemic has affected us, and where everyone sees the opportunity. But to give the attendees a little better feel for each of our firms, I'd like to first start by focusing on how each of you differentiate yourself and any niches or specialties that you focus on. Let's see, Mike, yeah, let's start with you. If you, who are your competitors in the medical receivable market, and how are you see yourself gaining advantage?
Thanks, Antonio. We are not aware of any direct fund competitors providing this strategy. We have run across doctors who have funded one-off strategies for various medical service providers and lawyers who may represent family offices. The key for us is to identify medical receivables companies that have a national network of medical service providers who are looking to discount their receivables. Our due diligence then requires that they have an excellent underwriting skill set with negligible default rates. And finally, they must, and this is important, require financing and find our terms acceptable because they are expensive to the overall profitability of their business. It needs to make sense for them for an overall profitability perspective. There are significant synergies that are required and a significant amount of due diligence on our part to consummate the lending relationship with an ideal receivables company. Thank you.
All right, fantastic. Matt, you're in the private equity real estate space. You got to be quite busy at the moment, but what differentiates your firm? Also in the same space, and has anything changed with this with the pandemic?
Thanks, Antonio. Can you hear me? Is everything good?
You're clear. Okay,
perfect. So again, our deals target 20% plus annualized returns, with 40 to 50% of that being depreciated out, high growth markets, and short-term capital hold. I think that the latter point is one differentiator. We structure our deals so the investor has their principal committed for only 2 to 3 years until they're refied out by the permanent construction financing. Second, we are individual investors too, and so we only pick deals that we love and into which we all invest. All the top management, including myself, have considerable capital co-invested in our deals. We eat our own cooking, and we love it. As far as what we're seeing in the market vis-a-vis private equity, private equity deals typically that we're doing now, they will start cash flowing in 2 to 3 years, and so hopefully by that time this is all over with. So we're not seeing a whole lot of difference. We are seeing construction costs. I mean, some of the advantages are we're seeing construction costs come down a little bit, so that's an advantage for investors. But we've got projects building now, and builders are on site. We haven't had any interruption, so so far so good.
Yeah, fantastic. Sorry for the delay. I'm muting in and out as you guys speak. Raphael, if you'd like to go next, any feedback on how can firms come in and do the same thing you guys are doing?
Well, I think certainly anybody can come in and try to do anything. Whether or not they can be effective at executing is really where the rubber meets the road. I think we differentiate ourselves significantly insofar as that we've been doing this since 2005, so we're in our 15th year of business. And really our sole core focus has been the acquisition and purchase of distressed, non-performing loans, everything that's kind of centered around litigation-centric actions. We basically buy bad paper. And I think that our experience and our view is really a fundamental component that sets us apart from a lot of the other guys that certainly came into the business during the crisis in 2008, but weren't able to sustain beyond that. And I think one of the fundamental components of that, and there are many ingredients in a formula, but I would think that some of that is really the fact that we become and have become and are a trusted partner for the lenders that we work with. So we don't even look for deals, they just call us, right? After 15 years of doing this, we have very deep relationships with lenders nationwide, and they need someone that they know has certainty to close, someone that they can partner with in a very contentious or heated litigation, someone that they understand knows the diligence process, isn't going to tire kick and retrade, things of that nature. I think that those elements are probably some of the ingredients that would certainly set us apart and would probably be a barrier to entry for someone that didn't have that realm of, of wherewithal or certainly that experience coming into the marketplace.
Appreciate that. Thank you. Dan, with regards to Comvest, how are you differentiating yourself in what I think is an increasingly crowded direct lending market?
Yeah, it certainly has been for 10 years and growing. That's changing, which we'll talk about. But in terms of how we differentiate ourselves, we try to be honest with ourselves about capital is not a differentiating factor. There's plenty of that out there. What makes us different is we're part of a private equity platform that has experience and operating resources in a couple of industries. So in healthcare services, in specialty finance and financial services, I have executives I can tap into to help us understand how to do a deep dive into a company, into an industry sub-vertical that we're trying to understand. And so there's a lot of places where that doesn't matter. But for an owner operator that's trying to pick a partner that understands his business, that can grow with him, the fact that I bring someone from his industry to the table who speaks his language is meaningful. And that's another area that's where we differentiate ourselves, is doing non-sponsored lending. Most of our competitors, the vast majority, are only lending to sponsored businesses. Because we have the private equity platform, we can lend to non-sponsored businesses. And it's a very different competitive dynamic. And the different competitive dynamic means not just better pricing, which is true, but really importantly to us, better structures. So that means better risk mitigation, and we're able to use that to structure more consistent results throughout the cycle.
All right, fantastic. All right, so I guess what I'd like to do now is, knowing how each of you, or how we each are good at what we do, want to really turn our focus on the present, maybe share how the COVID-19 pandemic has impacted your existing investments, the deal flow, how you're going about day to day. And then in the following section, we'll talk about how we might be taking advantage of the future opportunities. This time, let me have Raphael, let me let you go first. All right.
Certainly. So the question again is how is this pandemic impacting things? Is that correct?
Yeah, and maybe more specific to you, how's this current market environment impacting the business and your existing deals that you've done prior to the pandemic?
Well, all right. So it's interesting. We have a very our fundamentals for acquiring non-performing loans are very strict, and we basically don't buy anything where we're at anything greater than a 50 or 60% LTV. We might go a little bit higher if there's a stronger PGs and or we see other sources of repayment capacity. But in terms of our existing portfolio and where we're at, we've actually fared very well. We just recently did an analysis of our portfolio to see where we stand given the recent values, where we see them happening. And granted, we still believe that they're going to change, but the market would have to correct by 40 points for us to actually be at parity. So I think where we stand in the current portfolio, we're very comfortable with where we're at. In terms of forward looking where things are going, we are receiving a tremendous amount of activity and calls from our lending partners asking us to already begin looking at assets that while they begin what is called the TDR process, that's troubled debt restructuring, they understand that even though they restructure those debt instruments and even though the government is giving a pass to a lot of lenders in terms of not requiring the additional tier 1 capital once they impair the loans, they understand that those loans are going to be coming around later again, right? They're just kicking the can down the road by deferring payments. So we are seeing a lot of activity from the lending partners that we work with in that capacity. I think that the government-backed lenders are receiving support from the government in the terms if they're holding any agency paper. Certainly the CMBS lenders and private lenders, people who do direct lending and things of that nature, they obviously don't receive the government support, and so to the extent that they're not getting payments, we buy a lot of paper from private lenders, and they're contacting us. So our opportunity set has expanded exponentially. That's really the universe of what we're seeing.
All right, thanks. Dan, let me put, you've been speaking near the end. How have you seen your sponsors and lenders react to the current uncertainties that we have with this pandemic?
Yeah, so look, it's early. We've seen sponsors be supportive in their early days, and I think generally, as I'm talking to my competitors and peers, we're hearing that sponsors are being supportive in early days. But it's a real question of how long is this going to prolong? Is it a U or a W? In which case, I think you get different answers for the type of support that can be offered. But or as I'd like to say to my team, I think my view is there's one out in the top of the first in dealing with this. We're a month in, but there's aftershocks and knock-on effects that are going to surprise us in the months and quarters and even years ahead. So that's what we're preparing for. I think the government has sort of come in with the bazooka to state the obvious, and I think that was appropriate. But it has certainly deferred some restructuring and painful medicine that would have been needed in certain subsectors, and it's deferred it. But I think our view is that still needs to happen, and it's just a question of what's the catalyst that will drive that the acceptance of some painful medicine in some of the harder hit sectors. And unfortunately, I think it's going to be some failures that'll scare people into action. And I think that feels like us with where liquidity is, what's going to be needed to kind of move people to act and to take in the insurance, even at a high cost, just to make sure they weather the storm.
All right, apologies. Thank you for that. I was just queuing up, starting to see some questions coming in from our audience. Next, Mike, you want to tell us a little bit about how COVID-19 might be impacting your strategy or what you're seeing currently?
Sure, Antonio. It's a bit of a mixed bag for us. There really isn't any risk to the outstanding loans. They will be repaid, irrespective of the crisis. But we do expect to see a reduction in cases as a result of the stay-at-home mandate, with the corresponding reduction in motor vehicle accidents and related personal injury cases. For the same reason, we expect that there will be a delay in processing the pending cases. Having said that, offsetting such, we are seeing an acceleration in case collections as lawyers and their clients are eager to settle these cases with the receivables companies to expedite settlement proceeds. This translates into an early payment of our loan, which is good because then we get the 6% fee that I mentioned earlier. Additionally, medical service providers are also eager to discount their receivables to monetize such receivables and improve their cash flow, which provides our receivables companies some good purchasing opportunities. So, as I said, it's a bit of a mixed bag.
Okay, thank you. I think Matt, I think we're missing you. Tell us a little bit about the environment for you.
Yeah, so I would mimic a lot of what Raphael said. So, I mean, we've been in the business since 2005. We survived 08 and 09. We learned a ton of lessons. Our LTV average on our entire portfolio is under 55%. We're also very, very firm and conservative on our underwriting. Again, with all of us co-investing in these deals, the entire firm has an interest in protecting principal. We are seeing better deals. So our firm is structured. One of the things that makes us unique is that we've got 40 plus employees. So a lot of the folks who are in the direct lending business in the middle market might have 5 or 6 employees. They're great at raising capital, but once the train starts to wobble, they're not quite staffed up to handle more complex workouts. And so in this environment, every loan we underwrite, we're planning for every eventuality and assuming that we'll have to take it over. So we've already gamed that situation out. And our business model is such that we kind of operate like a private equity shop, and that we team up every borrower with a project manager that has considerable experience in the related real estate silo. So, for example, one of our project managers was the head of development for the city of Salt Lake for 7 years. And so if you're building a Walgreens or you're rehabbing a hotel, in a municipal area, we're going to team you up with that person who's going to be able to function like a strategic partner and help you succeed. But at the same time, they're also monitoring progress on that deal and can, plan for any contingency that they start to see it wobble. So firm LTV on the portfolio, curated deals, heavily involved in the success of each loan. Our existing portfolio and our funds is rock solid. The only thing that we're kind of seeing right now is things are taking longer. So, attorneys, anything having to do with attorneys or title, it's taking longer. Obviously, if you're in the courts, that's taking longer. But generally, our portfolio is very solid. In 08 and 09, despite, the market crashing, I think in between 08 and 09, I think we were up, 6% in the portfolio. So that's all due to that business model and those firm LTV caps.
Okay. Thank you for that. I'll briefly give you a little, some focus on, from my perspective, our business, Oak Shore's business, we buy portfolios of debt and we charge it off. From the banks charge it off, we liquidate it. Typically, our strongest months during the year are February, March, April, which not surprisingly is because of the tax refunds. And then summertime is our slowest. So this past March, our collections were record high, and we pretty much prepared ourselves for not expecting anything to come in for the next several months. We have some of our agency, the majority of them will pay out at the end of the month, but we do have a fair number that do it twice a month. So mid-month for April, we were surprised. We would normally, in a normal situation, we would be off maybe 10, April still strong, but maybe about 10% less than prior month March. This half month April, we're keeping our fingers crossed, but we're only 15% off. So effectively 5% off. And I'll reflect a little bit later as to why is that, but I'll compare that to outside of Oak Shore, but still deeply impacts myself. We have a shopping center, and it's been kind of interesting to feel like we're stuck in the middle with an insurance firm who's the senior provider. They're not doing any furloughs after going back and forth with them. We're down to interest only, but the tenants at the other end are squeezing us for support, and something that I would have expected with rock solid tenants. I do see that they're erring towards caution, basically telling us they don't want to make any payments until July. So this experience has really turned it on its head as far as sort of the priority of payments, and the biggest nuts are the first ones to look for results versus our ongoing stream of payment plans of $80 to $150 a month. It's almost like your cellular plan. It's almost more trouble to turn off that ACH than to just let it keep going. Let me pause here because we have several questions that have come in from the panel. So in the order that they've come in, questions from Alexander Gorstein. Let me read this out to the panelists. For CRE, or commercial real estate loans that are backed by COVID-19 sensitive properties, retail and hotel property specific. I'm not sure if you're also talking in terms of geography, hardest hit cities. Do you guys expect banks and private lenders massive expect we will want to offload their portfolios like they did in the global crisis? And if so, when do you expect it? Do you think we will see 2010, 2011 pricing, i.e. 50 to 60 cents on the dollar? Let me open it up to those of you on the real estate side. Someone want to go first?
This is Matt. I can go first. So fortunately we don't have a ton of exposure in that, but the few deals that we have, hotels, yes, they absolutely are getting pummeled. And so as far as the larger institutions, I mean, from our standpoint, we are actively negotiating exits on those deals where we can. And again, fortunately, because of our underwriting and our LTVs, we're pretty safe. But yeah, those deals are in terrible shape. So we're getting rid of ours as soon as possible.
Anyone else would like to ask on this question? Otherwise, I can move on to additional questions. Okay. Let's see. We have a question from Greg Blix. Raphael or Matt, have you had to suspend or reduce distributions to investors in these times? Appreciate your feedback.
This is Raphael. That was question was for myself and Matt, correct?
Yes, sir.
Yeah. No, we actually, our fund vehicle, the way that we're structured, we don't do distributions till the end of we have an investment window that is typically a 2-year investment window and a 2-year wind down. And we just recently launched a vehicle. So we're still in the first year of our investment window. So we haven't even begun distributions as yet. So I don't think that applies to us.
From our standpoint, so we structure our funds with a significant interest buffer in order to kind of flatten out the volatility so that we can pay out a 78 to 85 bip monthly payment. On our individual direct deals, we also typically, and this is, with 99% of our deals, we will pre-fund an interest reserve for the entire duration of the loan. So if it's a 12-month loan, which many of them are, we've pre-funded, the borrower has pre-funded that interest reserve. So it's cash flowing. The only time on an individual direct deal, if that deal becomes impaired, there's going to be cash flow interruption. The reason in the fund is basically taking a syndicated position in all of these loans, and we're building up that interest reserve rather than pushing principal back, which, hurts our profitability, but it helps the end investor because it does make that cash flow more consistent. We built our fund, the Secured Credit Income Fund, specifically with the retail investor in mind, who is seeking income from an asset-backed portfolio at the 55% LTV. So, if I could also just go back to the previous question, the person asked about the hotels. I would encourage I encourage you, if you are a buyer in that market, you can reach out to me individually because we can talk further about those opportunities. There's some great deals to be had. Let's put it that way. If you've got capital and that's your business, there's strong discounts on that side of the business. Thank you.
Fantastic. Thanks, guys. I did have a couple other questions coming in. Rob Colorine, I hope you're doing well out there. It's a question from Rob. Let me read it out. Let me try to figure out who best geared for. More regional or national footprints. Also, with a couple of them focused on healthcare, do you see added areas of getting placed in higher priority funding, i.e. by municipalities? I'm not sure if someone on the panel understands it, wants to take a stab at that. If not, I'll go back to Rob and get some additional clarification.
Yeah, I can take a stab at it. This is Dan.
Right.
So, I think if you're asking about the footprints of our borrowers, both regional and national, we certainly have some national footprints. I would say, and we're seeing our borrowers get hit with, we have some businesses that do electable procedures, deferrable, discretionary procedures, and we're certainly see our share of those being deferred and those businesses being shut down in many cases. And I think our assumption is that that's going to continue and be to some degree rolling. We're far from experts in how this is going to play out, but we tend to be glass half empty when we're planning. So we're looking at the liquidity of those businesses and assuming that they're going to need to operate some level well below at zero in some cases for foreseeable months, and at sort of 50% and less occupancy for several months or quarters once they open. So that's sort of our general assumption for as we look at liquidity needs.
Okay, fantastic. Thank you for that. I want to take one or two more, and then I want to turn back to the panel to see how we're you seeing opportunities on with the COVID-19 pandemic, and then I think that'll still leave us a block of time to answer any remaining questions. For anyone who wants to answer, how are you thinking about U.S. HY defaults and recoveries through 2021? How about for specifically for energy and retail? And apologies, I'm drawing a blank on the acronym for HY.
High yield, maybe.
Thank you very much. So anyone want to take a crack at that specifically for energy and retail?
Yeah, it's Dan again. I'll take a stab.
Take a stab, and then I think there might be someone behind you. Go ahead.
Okay, so I'll answer quickly. I think in energy and retail, recoveries are TBD. I mean, in energy in particular, both are going to be far worse than had been predicted as of a month ago, as of a quarter ago. They're bad and getting worse by the week and month. I think you're looking at levels that are in the kind of 10, 20 cents in several cases, and I think you're going to see a high level of Chapter 7 in both industries. So I think defaults are going to go through the roof, absolutely through the roof, and recoveries are going to be abysmal is the only way to put it.
Yeah, I would just add that we're definitely shying away from energy deals and even I think even retail. I think you're absolutely right. Retail is gonna take a hit for sure. So we're overly cautious on those in those sectors.
Okay, very good. I'm going to keep aggregating questions from the audience. In the meantime, what I'd like our panel to do is let's continue with the pandemic. Now, first, we're looking presently just looking forward, whether it's the next 6, and if you would be explicit about what you think it is it in the next 6 months, 12 months, 18 months? What is the sweet spot for each of your spaces? What opportunities are we seeing? Again, we can go around the room, but to Raphael, if you want to go first.
Yeah, certainly. So I think our position is that it's too early to really make any significant bold moves, and our strategy is really about preservation of capital. And maintaining a risk-adjusted return that at the end of the day just preserves our investors' capital. We have a saying in-house, and it's that we're into stay-rich investing, not get-rich investing. So with that in mind, we're very conservative, and we really, at the moment, we believe that it's premature to be making any significant acquisitions. Some of the ingredients in our formula are that, we stay away from tertiary or secondary markets and try to stick to primary markets where there's high levels of velocity, right? So, LA, Chicago, New York, Miami, major markets. But ultimately, we're not really aggressively pursuing it at this very moment. While we already are starting to see a lot of activity within lending institutions, we're not aggressively pursuing them. We just don't want to catch the falling knife. And I think that we've discussed it, and we're comfortable, we're comfortable leaving some value on the table and catching things as they start to go up. Now, obviously, of course, that's really the $1 million question is, when do you see it going back up? And is the recovery, is it a V, is it a U, is it a W, right? And if it's a U, how long is that flat line? Where's the plateau? So we're very, very cautious about making our acquisitions. So I really don't want to predict what it's going to look like, and I don't want to say that there's a sweet spot. There are asset classes that we are definitely staying away from. We are also creating vehicles that are very sector specific. We are doing a distressed debt fund specifically for hospitality. I think one of the panelists mentioned earlier, they're taking a beating. We're already seeing lenders taking hits as big as 40% on on hospitality assets. But that having been said, we are still, we're still in a pause and wait mode. So I don't think we're going to make any real bold moves at the moment.
Yeah, I appreciate that. Thanks, Raphael. Dan, do you want to chime in on how, where, if anything, things have changed for you based on the pandemic?
Yeah, so listen, I think we are conservative by nature, just that's the way we lend. My partners and I come from Cerberus in a prior life, and that's the way we think about risk. It's a kind of worst case scenario. It's really hard to plan for here, impossible to plan for here. And so we're just being super careful. We have dry powder. We're looking to invest it. We feel good about the portfolio. We have our challenges, but we think we're prepared from a structural standpoint, liquidity standpoint in the portfolio. And in terms of new opportunities, we're really looking for high quality names that we know, industries that we understand and are relatively unaffected. So places like data centers, cell towers, water infrastructure, some elements of the healthcare industry, although many elements of healthcare are obviously being lacked. So it's being very selective, being incredibly conservative on operating assumptions and liquidity assumptions, and just assuming this is going to take a lot longer than we think to get through. And as shown by South Korea and China, it's not over until it's over with a vaccine or a cure, which is a long ways away. So very cautious, but we have dry powder and we are absolutely looking for opportunities.
Excellent, great. Mike, I'm saving you for especially given the state of the healthcare system in the U.S., what's the potential for the medical receivables market? What do you see going forward?
Well, we're a bit relieved just from a strategy perspective, not from a political perspective, that Bernie Sanders or Elizabeth Warren did not get the Democratic nomination, because a healthcare for all would potentially result in a more efficient medical healthcare environment, where our receivables companies' profit is off of the inefficiency of the healthcare market. The fact that they can go to their medical service providers and get deep discounts on the billable amounts is a function of abuse that goes on in the system. So we were a bit worried that a medical healthcare for all situation come about. While it wouldn't impact us immediately, it probably would have brought the returns down from a fund perspective. In terms of the overall opportunity, we are only loaning money to the receivables companies at the rate with which they can deploy it. So as I said earlier, if the industry is seeing declines because just people are staying at home and there are less personal injury cases to be had, which is a good thing from a human element perspective, but less attractive from an investment perspective. And if the whole systems, the courts, the whole processing of medical claims is delayed for the same reasons, that just means that we won't be able to deploy the money. But our return should continue to be sustainable. We just won't be able to grow as fast as we might otherwise have hoped prior to the pandemic occurring.
Excellent, thank you for that. Just to check in, I want to check in with Mike Curcelli. I have on my timer 5 minutes, but you want us to go another, how much more?
Antonio, you can go another 10 minutes. I apologize for going over.
No, not at all. No, in fact, I'd rather focus on all the questions that are pouring in. This next question, if each of you will just state your name. I think it's a general question for Bella Lauber is asking, what are your minimum investment amounts? We can just kind of go in order. Dan?
Yes, minimum debt deal is $25 million.
Okay, but as far as from a limited partner standpoint, minimum investment amounts.
Oh, I'm sorry, I misunderstood. So
actually, that's a really good question. It's unsure whether let's talk about minimum deal size and also from on the investor side, limited partner side, minimum ticket.
Thanks for making me look good, Antonio. Minimum investment size is $1 million from our LPs.
Okay, very good. Matt.
So our minimum is 50,000, and our typical deal size is anywhere between 3 and 25 million, with the average being about 10 to 12 million.
Okay, very good. Mike.
Our domestic vehicle is 100,000. Our offshore vehicle is 250,000, and we don't have a minimum deal size.
Very good. And Raphael.
Oh, there we go. Sorry. Our minimum investment is typically, our minimum LP investment is $1 million, and our transaction size is anywhere from a minimum 500 up to about 20 million, but we will go larger if we co-invest.
Okay. And I think, if I'm not mistaken, that's everybody except for myself. Our typical deal, we'll be doing anywhere from 150 to $350,000 of acquisition a month. Any one lender, it could be anywhere from, could be as little as 25 to as much as 150. On our limited partner side, minimum investments are typically 100,000. For SMA accounts, it's 1 million. But happy to talk about some arrangements. All right. Would any of the participants buy loans in the secondary market? Transaction as forced sellers needs to unload securities. Trying to think. Mike, not really applicable for you. I think Raphael has kind of covered it somewhat. If you have some additional input, Matt Gilbert definitely, and Dan potentially.
Well, this is Raphael. Yeah, we do buy loans in the secondary market. We trade loans into the secondary market. When we acquire distressed, non-performing loans and we make them reperform through structuring workouts, we will also sell them back into the secondary market as well. That's one of our exit strategies.
Okay, great. Matt or Dan, do you have anything to add there?
This is Matt Gilbert. Yeah, so we do expect, we will come in and pick up deals. I mentioned those groups before that have 4 or 5 people who can't manage their workouts. There are opportunities for us. We're always opportunistic, so in some cases we will come in and pick up those loans.
Okay, excellent.
Yeah, this is Dan.
Mike,
very quickly, we can do secondaries. We like secondaries. We're generally looking to do them direct with the party that holds them as opposed to through an agent. And so we tend to try to find who the holder is and approach them directly.
Okay. And then I guess between the, in your field, Mike, is there a secondary market? And if so, do you get involved in it?
There really isn't, because we're basically just loaning to individual receivables companies that we've underwritten and done all of our due.
I just wanted to give you, not being able to look you in the face, I wanted to double check.
No worries. Thank you.
On our end, we for sure, our strategy is to be larger than the little guy, and then the largest deal we want to look at is smaller than the big institutional and publicly traded debt buyers. So we buy direct from lenders. Unlike real estate and debt buying, your counterparty risk is quite high. There's no title company out there guaranteeing that the asset being sold is what it is and it's unencumbered. So the partnerships with buyers, but we definitely buy direct from originating lenders, and then there is a secondary tertiary market where we then sell off smaller portions after we've collected it at a lower piece, but we field it down the funnel, if you will. Similar to what happened in 08, it's counterintuitive for people outside of the space, but some of the best margins occur in these times, both debt buyers that their credit dries up or they can't continue doing the monthly acquisitions. We're absolutely involved in buying secondary opportunities, but again, we're very careful with the counterparty and really we won't buy from someone that isn't known in the field. We're definitely interested in it. Clarify about second market sources of distressed debt. We'll type that out separately if that was to me. If it was aimed at someone else, you can clarify your question, Sharif. Matthias says, would any of the participants buy? Yeah, we covered that. All right, so I have on our clock We still have a few more minutes. If there aren't, let me double check. Says we still have 4 more. Sharif is directed to Safe Harbor. Can you clarify about secondary market sources for distressed debt?
I'm assuming, that when they say clarify, the sources that would be CMBS lenders, that would be one source. Is that?
Where is distressed debt being sourced? Banks, special servicers, auctions.
All of the, so all of those are sources for distressed debt, without a doubt. We typically aren't buying it from places like that, although we do, they approach us. We're typically dealing with stuff that's off market only because we have relationships already with existing institutions and they prefer to work with people that they know. So, but we do buy in the secondary. We do buy from all of those different sources that were mentioned.
Very good. Thank you, Raphael. Neighbor to buy loans. Let's see, Alexander Gorstein, is the panel seeing opportunities in CMBS world yet? If so, where and what pricing? I don't know if Dan, you or Raphael have anything to add, Alexander.
I would be happy to. I'd be happy to comment on that. The CMBS lenders are actually looking to sell some of their assets now. We actually are speaking with them, but as I mentioned earlier, we really, you have to be able to strike a value on assets, and not knowing where the market is really puts you in a cautious state. And I think that's where we're at. As far as geography, I'm seeing it all across the country, everywhere. And very specifically, where I'm seeing the most distress is in hospitality. But so again, but while that is and they are actually selling some of those assets, but again, we're concerned about jumping the gun and moving on anything too quickly, and so we're taking a pause and wait and see attitude.
Hey, Antonio, it's Dan. I can't comment on CMBS, but I did want to make one comment about the secondary trading.
Hop on in.
It's interesting. A month ago, there was the spread gapped down significantly. Prices gapped down significantly for about a week into the kind of low 80s in direct lending land. They've since traded up significantly since then. So there's not much trading going on because there's a big bid-ask spread generally. And the banks have been told by the OCC that they've got a holiday, someone alluded to earlier, to deal with their problems. So they're not liquidating yet, but I think it's really a matter of time. And you're going to start to see in the coming months and quarters more secondary activity. I think a meaningful pickup in secondary activity.
Okay, great. I saw at least one or two questions from my friend Jeff Marin, but it's out of my open queue, so maybe someone on Flya has responded to that. If we didn't get, I'm going to go back through after this panel, make sure all the questions that were posted got answered. If I missed any, apologies, but I want to thank everyone on the panel for your time today. It was an honor to be here with you all. And we'll be here. I'll be here the rest of the day. If there's any additional questions, I'm happy to answer them for myself or to my panelists. I'm happy to forward them on to them. With that, Mike, I think our time is up.
Thanks, everybody.
Thank you, guys. Thank you very much.
Thank you, gentlemen.
Thank you.
Well, good afternoon, everyone. I would like to thank you all for joining us today for the Flya Real Estate Direct Lending and Private Debt Forum. We would like to thank our sponsors once again, Preqin, Millennium Trust, Apex One Investment Partners, and Entrust Global. We would also like to thank our panelists for a fantastic day and a fantastic panel. Hopefully the information provided you will find useful and timely in these challenging times. As a reminder, our next forum in the series, part 3 is May 19th and 20th. Part 4 is June 23rd and 24th. And conditions permitting, will be in New York City on July 16th. Once again, thank you for joining us, and we hope to see you May 19th and 20th for part 3. Have a good day.